Let's begin with the biggest story in the corporate world, where Asian shares are tumbling and oil prices have dropped. This after US Central Bank, Fed, unleashed another big rate hike. US Central Bank, it pumped up its benchmark interest rates by 3/4 of a point. For its fourth straight time, it's 0.75%, but it hinted it could soon reduce the size of its rate hikes. Now, the recent hike also signaled aggressive campaign to curtail inflation. It could be approaching its final phase in the US. Fed's move raised its key short-term rate to a range of 3.75% to 4%, highest level in 15 years.
The FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that.
So it was central bank's sixth rate hike this year, a streak that has made mortgages and other consumer business loans increasingly expensive. It heightened risk of recession as well. That's a worrying factor. It's what experts have to say on US Fed recent take.
It was widely expected that the Federal Reserve would raise rates by 3/4 of a percentage point for the fourth consecutive time. What they've done at this point is indicate that whether it's December or a meeting thereafter, they're likely to slow the pace of the rate increases. Instead of taking those 3/4 percentage point supersized chunks, they may dial that down, maybe raise rates by 0.5 percentage point, eventually maybe 1/4 percentage point. But the bottom line is this: they're still going to keep raising rates through the end of this year and likely into 2023, because inflation, which is the whole target, that's the whole reason they're raising rates, really hasn't shown any signs of any material moderation.
And the persistence of inflated prices and higher borrowing costs has undercut ability of Democrats to campaign on the robust health of the job market as they try to maintain control of Congress. WION now available in your country. Download the app and get all the news on the move.